Hi, and welcome to another great webinar that we have for you today covering Roth conversions and associated strategies. My name is Alex Perney. Thank you everyone for tuning in to listen to this. Unfortunately, this is a re-recording of the original webinar that was done, as there were some issues with the initial recording. So unfortunately, we won't have the good Q&A back and forth, but for those that wanted to circle back, the content is going to essentially be the same here. My name is Alex Perney. I've been with Advanta since about 2012. And again, we'll be going through some Roth conversion strategies and kind of going over what the actual function of a Roth conversion is here today. Now, it's very important that people understand that with Roth conversions, these are taxable and reportable events. So we need to make sure that we disclaim that anything provided here is for informational purposes only, and Advanta IRA and our employees do not provide investment or tax advice, nor do we promote or endorse any products. Everything provided here today is for educational purposes only. So let's go into a little bit of the history of Roth IRAs, because they haven't necessarily been around for as long as traditional IRAs, and I think a good little snippet of history is always beneficial to everyone. So traditional IRAs have been around since the mid-1970s, with the passing of the Employment Retirement Income Securities Act of 1974, more commonly referred to as ERISA. Now, the next like 10 years or so kind of had a little bit of back and forth with some legislative things coming forward to see what actually would be allowable, and it didn't actually come until the mid to late 1990s that we actually got Roth IRAs. So for about the past 28 years or so, Roth IRAs have been a thing, and people have greatly enjoyed them. And then in the mid-aughts, we had Roth 401ks, which also are really cool functionality to allow you to make after-tax contributions to 401ks as well. And Roth conversions can be done intra-plan, meaning that you're doing them from 401ks into an IRA or in plan, as in a Roth 401k conversion internally. So there are a lot of different functions that are available to people. If you don't necessarily have a Roth account already, we're going to kind of show you how you can do that, and also how there are some misconceptions on people that may think that they don't qualify for a Roth IRA or aren't allowed to open one. We'll also kind of go through that as well. So I just want people to understand kind of where these things have come from, and a little bit of the history associated with that. So let's look at the kind of constituent factors that make up what you're going to need to have in order to be able to do a Roth conversion. The first is some type of pre-tax money. Now, that is typically going to be held within a traditional IRA or a 401k. So anyone with earned income is eligible to contribute to a traditional IRA. However, the deductibility may be limited based on your annual income, and we'll get into those limitations here in a minute. But it's important to understand that you have to have some type of pool of pre-tax money in order to be able to convert it. Most oftentimes, traditional IRAs are going to be what people use to funnel their pre-tax monies from like a 401k, a 403b, a governmental 457, a governmental thrift savings plan for the armed forces. This is where a lot of the funds come into these types of plans, and that's a good benefit of the traditional IRA, is that it's kind of a landing pad for all of these different pre-tax funds that people typically have. Now, the benefits of a traditional IRA, again, Roth IRAs aren't necessarily a good fit for every single person, and it's good to understand kind of what exactly the benefit of pre-tax funds are and what the benefit of after-tax or Roth funds are, because having an understanding of both of them is going to really help you tailor your strategy and understanding of what's going to best fit you. Because although Roth IRAs certainly do get a lot of press, and I think everyone would agree that paying no taxes is better than paying some taxes, there is a barrier to entry to this, and it is going to be a net higher present tax bill that you're going to have to pay presently, because you can't just get money into a Roth IRA without paying taxes in some form or fashion. But we'll show you some strategies associated with doing so. Now, again, benefits of the traditional IRA: you get a tax deduction for lowering your current tax bill. Again, your eligibility for that deduction might be phased out a bit. You do have tax deferred growth, meaning that anything that you invest in with a traditional IRA is tax deferred. But the nice thing is you don't have to track underlying basis or anything like that. None of the actual investment income or returns are taxed at that present value, meaning that, let's say, for easy example, you bought an asset within an IRA for $100,000, and then you sold it years, months, however long the term is, later, and had an appreciable gain of, let's say, $100,000. You hit it out of the park, 2 extra money. Well, that's not taxable within the traditional IRA, nor is it taxable in the Roth IRA. It's important to understand that the life cycle of the investments aren't going to be spitting out random taxation, and you aren't going to have to track capital gains or any other types of basis throughout the life cycle of the account. It's really simplified for a traditional IRA. You get a tax deduction going in, and then when you distribute money in retirement, you're just taxed on the money you take out at ordinary income. Now, granted, ordinary income can be some of the most garrulous taxes to deal with, and having a Roth IRA when you have a qualifying distribution does obfuscate that. You do not have to pay taxes when you take a distribution out of a Roth IRA, so long as that it's qualifying. And again, we'll get into some of those things a little bit later on as well. So traditional IRAs aren't some inherently worse vehicle, or pre-tax investing isn't inherently some type of worse vehicle than Roth or after-tax investing. It's just important to understand where these things fit and understanding what is going to be the best decision for you when it comes down to allocating pre-tax versus post-tax investments for your retirement plans. Now, old 401ks can be rolled over to a traditional IRA with no tax consequence. However, if you do roll an old 401k into a Roth IRA and it is pre-tax 401k dollars, you would be taxed on the entirety of that rollover. That's what's called an indirect Roth conversion. There's really nothing too fancy about it. It's just however many dollars that you elected to roll over from the pre-tax traditional 401k to the Roth would be calculated as additional income for that given year. So now let's look at some of those deductibility phase outs that I mentioned. So if you make over a certain amount of money and you are covered by an employer plan, then the contribution to a traditional IRA may not be deductible. Now, this also leads into another strategy of thinking, okay, well, if I can't make a deductible contribution to a traditional IRA, why don't I make it directly to the Roth? Well, again, therein lies the issue, is that these phase out limitations are almost directly in line with the ability to directly contribute to a Roth. But there is no income limitation to being able to do a Roth conversion. There was some legislation that came out about a year and a half ago that was aimed towards reducing a lot of things in the retirement plan market of investments and things like that. But one of the provisions was to limit the amount of earned income that someone could have and still be able to do a Roth conversion. Fortunately, all those things were stricken in committee, never made it out into the actual bill, so we don't have to worry about that. It doesn't matter how much money you do or don't make, you are always allowed to do a Roth conversion. So if you have to make a non-deductible IRA contribution, then maybe doing a Roth conversion of that contribution wouldn't be a bad thing. Now, keep in mind that you may have some additional or partially double taxation on that. You do have to track the underlying basis of that non-deductible contribution on IRS Form 8606. So it's definitely something that gets to be a little bit more complex, and I would always recommend you check with a tax advisor before doing this. A lot of people also like to call this the backdoor Roth conversion as well. So when it comes to deductibility of traditional IRA contributions, here's a few things to look at. If you are a single active participant and you make between $68,000 and $78,000 per year, then you are going to be phased out in that range of being able to deduct a traditional IRA contribution. So if you make your $6,000 or $7,000 annual contribution to a traditional IRA and you make $68,999, you can deduct the entirety of that contribution. If you make $78,000 even for a given year of modified adjusted gross income, then you can deduct none of that contribution. So I think you can see how that works. Now it scales up from there. So married active participants filing jointly, you're going to be between $109,000 and $129,000 of earned income. And then if you are covered by a active retirement plan, and if you are covered by an employer-sponsored retirement plan, and you make between $196,000 and $206,000, then you also cannot deduct after that the traditional IRA contribution. Now, just keep in mind that you have to note that you don't automatically get a deduction for adding money into a pre-tax retirement plan. Unlike 401ks, traditional IRAs do have an income limitation phase out for the deduction of those contributions. So this kind of circles back to me telling people that you need to check with a tax advisor to make sure that what you're doing is in line with your ultimate tax strategy. A lot of people are just under the assumption that if you can make a non-deductible traditional IRA contribution, then converting it there really is no reason not to convert it to a Roth IRA. Even though you can't directly contribute to that Roth plan, you can always do that backdoor Roth conversion. Again, always check with your CPA or tax advisor and understand that there might be additional tax filings you need to do, i.e. Form 8606, that would have to be filed in order to properly track that non-deductible basis of your traditional IRA. Now, what are some distribution rules for traditional IRAs? Again, this is going to kind of encompass the cost benefit analysis between going with a traditional versus a Roth IRA. So with a traditional IRA, if you add money into that plan and you need to distribute it at any point before the age of 59 and a half, you're going to have a 10% early withdrawal penalty and have to pay income tax on those funds distributed. So let's say for sake of argument that you had, let's say for sake of argument, you had contributed $10,000 to a traditional IRA and you needed to take a distribution of that and your age is 40. Well, you would have to pay a $1,000 penalty to the IRS for doing so. And then you would also have to pay income taxes on that additional $10,000 distribution, the whole distribution. You don't get to net out the penalty. You distributed $10,000, you have to claim additional $10,000 as tax and also kick out a $1,000 penalty to the IRS. So these are a lot more restrictive with regards to keeping you within that retirement tax shelter. Now, for people looking for a plan that might offer a little bit more flexibility, the Roth does offer some additional flexibility in your ability to make distributions of capital from that account before the age of retirement or 59 and a half. We'll get into the specifics of that here in a moment, but it's very important to understand that traditional IRAs are going to be very restrictive for being able to withdraw funds while you're still actively participating in, or I shouldn't say actively participating, but before your age of 59 and a half. Now, traditional IRAs also have a required minimum distribution. The thought being is that the IRS has never gotten to tax any of the contributions or earnings in this plan, so they require you at the age of 72 to start drawing down that account. Now, it's not some type of specific ratio or anything. It's roughly 1 to 3% of the account value, depending on a few factors like whether you're married, whether you're single, things like that, and also what the account value of that plan is. The IRS has life expectancy tables, not exactly the most entertaining reading, but it's easy enough to plug and play and figure out what your required minimum distribution would be with your account value and a few other factors. Now, I mentioned that there's a 10% penalty for withdrawing funds for at any time before the age of 59 and a half from a traditional IRA. However, there are some exceptions to that 10% penalty. You still have to pay taxes on these funds, even if you're exempted from the 10% penalty. But the 10% penalty exemption includes distributions for higher education expenses, expenses related to disability, first-time home buyers, and if you have an inherited IRA, even if you're under the age of 59 and a half, you don't have that 10% excise tax penalty that must be paid. Now, some rules for an inherited IRA. So if you inherit a traditional IRA from someone, if the beneficiary is a spouse, the IRA is treated as their own and subject to normal distribution rules. So if you were under the age of 59 and a half and your spouse dies and leaves you their traditional IRA, then you would still not be able to do a distribution from that without a penalty. You would have to wait until you reach the age of 59 and a half. If the beneficiary is not a spouse, then the IRA must be distributed within 10 years, and the 10% early distribution penalty is waived for that because it becomes an inherited IRA. There's a lot more that goes into inherited IRAs. We did a webinar, I believe about 2 weeks ago. You can search it right on our YouTube channel if you just go to the search bar and search inherited IRAs to see some more things that go into what exactly those are, because the rules and regulations regarding inheriting a retirement plan are its own class in and of itself. So again, that's kind of the general rules with regard to traditional IRA distributions, and it gives you a good idea of what exactly you're getting into when you elect to go the pre-tax route versus the post-tax route. Now again, the strategy that most people use is a combination of both. If you want to have zero tax in retirement and you can play your tax game right and be able to make more money than you were paying in taxes to go the post-tax route, then certainly a Roth might be a good fit. But again, good to understand how these things work and what the rules associated are with each to determine what strategy is going to be best for you going forward. Now, a Roth IRA. Anyone with earned income that does not exceed the income limits is eligible to contribute. That does not mean that if you are ineligible to contribute directly to the IRA, to the Roth IRA, that you cannot have one or open one, and I'll get to those phase outs for modified adjusted gross income here in a moment. Anyone can have one. If you make $1, if you make $1 million, if you're making $10 million, you can always open a Roth IRA. Your ability to directly, and I use that word specifically, directly to contribute to it may be affected by how much money you make, but anyone can open one. That's a severely over-distributed inaccuracy in retirement plan information is that you cannot have a Roth IRA if you are over a certain income limitation. Not the case. Anyone can open up a Roth IRA. It's just your ability and the mechanism that you have to utilize in order to get money into that plan that's affected. And that's where Roth conversions come in, is that no matter how much money you make, remember I said a little bit earlier that there is no income limitation phase out for people that are doing Roth conversions, and that is exactly true. So you can always open up a Roth IRA and contribute to your traditional. Remember that deductibility might be affected, but you can always have both of those plans and then just do a conversion from your pre-tax traditional IRA to the Roth. You could even do that of your contribution. So again, that's the mechanism for it. People like to call it a backdoor Roth conversion or backdoor Roth. I just like to call it a Roth conversion. So that's what you're looking at with that. So again, Roth IRA criteria, anyone can have one, just your ability to directly contribute to that plan is going to be affected with your income for a given year. The benefits of a Roth IRA, you have tax-free earnings and no taxation on withdrawals, so long as that a few items are met. Namely, the account has to be open for at least 5 years, and you have to be the age of 59 and a half, but then any and all earnings are going to be able to be distributed tax and penalty free at 59 and a half. So if you had $1 million in a Roth IRA and it's been open for 5 years and you're at the age of 59 and a half, you could write yourself a check for $1 million and pay a grand total of 0.00 taxes on that money. Pretty cool deal. But again, we'll get into some reasons why you have to really look at how much money you're earning, because if you're paying half the money in the conversion on taxes going in, then you would have to at least make up that deficit in your earnings in the Roth IRA for it to be a good fit in the end. Again, all things that need to be considered, we're going to kind of go through here in a minute. Now, another big benefit of Roth IRAs is that you have no mandatory withdrawals. One of the downsides of traditional IRA investing is that once you get to that age of 72, you have to start drawing down that account. If you don't need the money, and let's say you're still in a relatively high tax bracket, or again, you just don't need the money and don't want to take it out and pay taxes that you otherwise wouldn't be paying, then a Roth IRA can be a very good strategy for you, especially once you start getting closer to retirement. Maybe or start getting closer to 72, maybe you've stopped working, you have other life factors, maybe you're making significantly less money. So being able to do Roth conversions in a low tax bracket to try to get all of your money out of pre-tax accounts into a post-tax Roth IRA might be a good strategy to then in turn afford you the ability to continue your retirement investing while not having to take required minimum distributions and pay any additional taxes. Go back. So here are the contribution phase outs for Roth IRAs. If you're a single individual and you are making between $129,000 and $144,000 a year, that is your phase out for Roth IRA contributions, meaning that if you make over that as a single individual, make over $144,000, you cannot take your $6,000 or $7,000 contribution and plug it directly into a Roth IRA. You can plug it into a traditional IRA and then convert it to a Roth IRA, but again, you cannot do it directly to the Roth IRA. Again, backdoor Roth is what people like to call that. If you're married filing a joint income tax return, your phase out is between $204,000 and $214,000. And if you're married filing separate returns, it's going to be $0 to $10,000. And again, if your AGI is too high, just a gross income, you cannot contribute directly to the Roth. You have to do it through a traditional first and then convert it. And this doesn't mean that you can't have a Roth. If you had a Roth for years and you start making more money, you're doing better in life, that doesn't mean the Roth has to go away. The Roth can always remain in place no matter how much money you do or don't make. Just your ability to contribute to the plan is the only thing that's affected. And the reason I kind of harp on that is that it's so prevalent that people have this misunderstanding of this basic fact with Roth IRAs that I really like to make sure people get the point that that is not the case. Anyone can have a Roth IRA. It doesn't matter if you're worth $1 billion or if you're worth 10 bucks. Anyone can have a Roth IRA. There's just some rules on how you actually get money into them that is going to be in play here. So what is a Roth conversion? Again, that's why you tuned in. What is a Roth conversion? It is taking an account with pre-tax contributions and earnings. This is typically going to be a traditional IRA. It can also be a SEP IRA, a simple IRA, an old 401k, or a current solo 401k. Any of these types of accounts can be converted from pre-tax to post-tax. So it is the transference of funds into a post-tax account. And you are electing to pay the tax on these funds or assets now that are transferred over rather than having them grow tax deferred. Going forward, the funds grow tax-free within the Roth account. In short, you pay the taxes now rather than later. You're paying tax on the seed that you plant and nothing on the fruit that you take off the tree. So again, Roth conversions. Now, the tax that you pay, so in this instance, if you move $100,000 from a pre-tax traditional IRA, SEP simple 401k, into a Roth IRA, you're going to get IRS Form 1099-R showing that you did a taxable event, which is a Roth conversion, of that $100,000 into the Roth IRA. You're going to claim an additional $100,000 of earned income for that given year. It's just going to bump up your adjusted gross income by that $100,000. So it's very important to understand that your taxation on this is not some type of bespoke calculation. It is going directly into your 1040 as additional income, which can be very garrulous considering earned income has some of the highest tax rates in the United States right now. So making sure that you do these either incrementally or in years which you have losses or deductions or things that offset your adjusted gross income for the year is a very sound thing that you need to discuss with a tax professional to make sure that, again, you're not getting hosed on taxes, even though that taxes typically are going to be lower at present value. If we look at a historical graph of taxation in the United States, it kind of sits at a pretty steady upward trajectory going left to right. Taxes are higher now than they have been in the past, and that will probably continue to go along with that. So making sure that you're not going to be paying an over amount of taxes as compared to what your earnings potentially would be and what your taxes might be in retirement is very important in looking at this, because 1099s are reported to you with the converted amount in the year in which you do that. And it's also important to understand that you do this within a certain time period. Roth conversions are done January 1 to December 31. You have the whole 365 days of the year to do it, but there is no such thing as doing a previous year Roth conversion. And you also cannot unwind a Roth conversion any longer. There was a block of legislation back in 2018 that got rid of Roth recharacterization. So if you do a Roth conversion, you better be sure it's what you want to do, because you're stuck with it once you do it. So you have until January 1 to December 31 to do a conversion. There is no AGI limit for converting to a Roth IRA. The fair market valuation of any conversion is reported on IRS 1099-R in the calendar year in which the conversion is done. Now I say fair market value. Now cash is easy enough. You have $1, you have $100,000, you convert it, you get a fair market value report of that. You converted $1, you get a 1099 for $1. You convert 100,000, you get a 1099 for 100,000. Million. That's easy to understand. But you don't necessarily have to do conversions at a cash value or a cash basis. You can convert assets, and especially here at Advanta, where all we deal with is more or less traditional, non-traditional assets, so things that aren't publicly traded without a readily identifiable value. The strategy for doing some of these things opens up a little bit of a window to get creative with some of these things, and also try to maybe mitigate having to do all of the conversion in 1 year. It's important to understand the timelines for doing a Roth conversion, because that can actually play into your advantage of trying to mitigate your taxes by understanding that the window being January 1 to December 31 means that you have a brief window of time at the end of every year to do a conversion of, let's say, maybe either a large tranche of cash or an asset, and be able to split that conversion over 2 years by having a very short window to do it. So maybe in the path of 2 weeks, you get to convert something and split the tax bill over 2 years, and then also have that conversion done in a timely manner in order to be able to maybe do a new investment just with that Roth IRA basis. Again, that's important. We'll get to that in a moment. Again, you cannot convert for previous years once you hit December 31st at the stroke of midnight. That's when you turn into a pumpkin for it. You no longer are able to do it. And if your AGI is too high to contribute to a Roth IRA, you can first contribute to the traditional and then convert those funds into a Roth IRA. All right, distribution rules for Roth IRAs. These are very different from traditional IRA distribution rules. Some of them are similar, but I would say that on the whole, they are significantly different. The Roth IRA, you have a 10% early withdrawal penalty for any earnings attributable to your contributions if you are under the age of 59 and a half. Again, this does not apply to contributions. So if you had $10,000 of contributions and you had $3,000 of earnings attributable to that $10,000 of contributions, if you distributed $10,000, you'd pay zero tax, zero penalty, because those contributions are basis. If you distributed in that same scenario of $10,000 of contributions and $3,000 of earnings, if you distributed $11,000, you would have to pay a 10% penalty on that $1,000 distribution. So you pay a $100 distribution penalty, and then you'd also pay tax on that $1,000 of earnings that you distributed before you were eligible to do so. The 59.5 rule and the 5-year rule means that you can distribute earnings. It's really referring to your ability to distribute the earnings on your contributions tax and penalty free. Granted, most people say you get tax and penalty free distributions once you reach 59.5, but it's a little bit more complex than that. Think about a Roth IRA distribution, kind of like shooting an arrow at a target, a paper target over a hay bale. The first thing that arrow is going to hit is your contributions. So you always distribute from contributions first. And then once that arrow pierces the target, it gets into the earnings, and that's when you distribute the earnings. So if that same analogy, that arrow is always going to be hitting that paper target first, and then that hay bale is going to be the earnings, that's how you always order your distributions. Now that means that you have to track distributions from a Roth IRA, which isn't a big deal if you never take a distribution from it until you're 59.5. It's all gravy and you don't have to worry about it. But if you need to take a distribution, let's say, for example, again, you had $10,000 of contributions and $3,000 of earnings. In year one, you distribute $5,000 from that IRA. So now you're left with $8,000 in the account at the end of that year. Let's say the following year, you have an additional $1,000 of earnings. So now you have $9,000 in the account, and you distribute an additional $5,000. Well, now you have $4,000 left in the account, but you have no contribution. So in that third year, if you want to distribute anything from that account, it's all going to be earnings attributable to earnings and not earnings attributable to contributions, and you would have to pay taxes and penalties appropriately on those distributions. So Roth IRAs do get a touch more complex if you ever need to distribute money out of them, because you always have to track your basis of contributions to the plans. Otherwise, you're going to be in a world of hurt when it comes to tax reporting if you did not pay taxes on something that you otherwise needed to do. So tax-free income after 59.5, after the Roth IRA has been open for at least 5 years. The exception to that 10% penalty if you're distributing earnings is included the same thing for traditional IRAs, higher education expenses, disability, first-time home buyer, and inherited IRAs. Now, your conversions, if you're under the age of 59.5, are always going to have its own 5-year waiting period before it's considered basis. So let's say, again, let's go back to that example of $10,000 of contributions and $3,000 of earnings. And let's say in that year that you convert from your traditional IRA an additional $10,000. So now you have $23,000 in that plan. You have $20,000 of total contributions and $3,000 of earnings, but you have to track that $10,000 with its own 5-year waiting period in order for it to fully be considered basis contributions. If not, and you wanted to take a $20,000 distribution, you would have to pay a 10% excise tax penalty and income tax on that converted amount that you distributed. So that $10,000 portion of that distributable basis would be penalized for taking it out. I know it gets a little complex, but it's important to understand that you really kind of do your research if you ever do need to withdraw out of this plan. And also, especially if you're doing Roth conversions and might need to access some of these funds at an earlier date than 59.5, just to understand that there is separate aging for the 5-year period to have those conversions be considered basis, because it is a Roth conversion contribution. And again, that will go into that bucket that gets hit first with the distributions from the Roth IRA. And again, contributions are considered first in, first out. Conversions are distributed second in this whole scenario. So initial contributions, then conversions, then earnings. So why convert to a Roth IRA? That's a question that everyone wants to know. Well, not paying any tax on a distribution is a pretty sweet deal. I think, if I could get a picture of everyone's hands raised, that anyone that I asked saying, hey, would you like to pay some tax or no tax, people would by and large say, I'd like to pay no tax. So why convert to a Roth IRA? You expect large returns on investments in future years, and having that being able to be captured by a Roth IRA and not have to worry about any taxation on that is a pretty enticing opportunity. You have a long time before retirement, so you have time to continually build up earnings that are going to offset the taxes that you would have to pay for getting the money into that Roth IRA initially via the Roth conversion. Because remember, the converted amount, whatever the value of that, whether that's cash or assets, is going to adjust up your AGI by that amount in any given year. Traditional IRA contributions are non-tax deductible. Great reason to dump that into a Roth IRA with a conversion. If you're not getting a tax deduction, might as well go ahead and get it into the Roth IRA anyway. you have losses to offset income from the conversion. So if you had a given year where you had heavy losses or you had some type of deductions or credits that are going to offset your AGI for a given year, great opportunity to do a Roth conversion. Estate planning and your ability to pay the tax due on the conversion. Remember, that is something that you need to look at from maybe a perspective of why to or why not to convert to a Roth IRA, is that the Roth conversion tax liability is paid personally. You definitely would not want to have it paid out of the retirement plan because you would get hit every which way, front, left, and center with taxes. So if you wanted to have your taxes withheld from a Roth conversion, you'd have to pay taxes on the entire converted amount. So let's say for easy math, you decided to convert $100,000. Well, you get a 1099 for $100,000, but then let's say you wanted to have us withhold 20% of that conversion. Well, then you'll only get $80,000 into the Roth IRA. You'll pay tax on the whole 100, and you'll also get a 1099 for a separate distribution of $20,000, which might have a 10% early withdrawal penalty. So you might have a $2,000 penalty plus another $20,000 of applicable taxes that are going to be due. Now, keep in mind, Roth conversions do not have an early distribution penalty associated with them. So you don't have to worry in that scenario about having an additional 10% on that whole 120 or the 100 of the initial conversion. But you're going to have to understand that if you want to have taxes withheld and have a tax withholding payment sent, it's going to be a bit of a crunch. So you definitely need to make sure that you have the ability to pay the taxes on a Roth conversion before you actually get in and do it. And again, why not to convert to a Roth IRA? There's just as many reasons to do it as not to do it. Let's say you're close to retirement and not expecting any significant growth in asset values, then, paying a bunch of taxes is really no different than just incrementally distributing funds and paying taxes incrementally instead of in one large tranche. You're going to be in a much lower tax bracket in retirement, so maybe doing the incremental distributions isn't going to really make much of a difference between taxation now and doing conversion. Your asset values in your IRA are inflated because remember, you pay fair market value of whatever the assets are in the conversion. So if you're converting tangible assets like real estate or something, then you're going to have to pay taxes on an inflated value. It's especially true right now with real estate prices being what they are. Again, they are starting to mellow out a little bit, but they are still significantly inflated. So having to pay taxes on an inflated value, not going to be a good shake. I don't really care who you are, unless of course you have large losses that are going to offset that personal income, then yeah, go ahead and do it. The income from the conversions may result in a loss of other benefits, maybe a child tax care credit or Medicare premiums, because remember, this is calculated as income to you. So if you have some type of social benefit, that might be affected by this. So you definitely don't want to do something that's going to affect some type of maybe social program that you need to use to live. It's definitely something that you don't want to mess around with. And if you want access to the funds within the next 5 years, because you have to have that aging period done on the Roth conversions as well as the earnings. So if you converted a traditional IRA right before retirement, let's say you had $250,000 in a traditional IRA and you converted it right before retirement, well, if you retired the following year, you'd have to wait another 4 years to access your money without a 10% penalty. So again, I think that's pretty easy to illustrate of that not being a very good shake, and something you need to look at if you're looking to maybe look for a reason not to convert to a Roth IRA. So what will you need to convert a Roth IRA? Well, if you're just doing cash, besides just notifying your custodian, nothing. They just do cash at a par value of dollar for dollar, easy enough. But if you're going to be doing a conversion of a tangible asset, and again, tangibility is subjective, so things like real estate, private placements, notes, anything you're going to be doing a conversion of, you have to have two things. You have to have a qualified fair market valuation from an independent third party. So if you're doing real estate, can't use a tax bill, can't use a comps, can't use Zillow. You need to get a certified appraisal of the property in order to be able to convert it. And you also need documentation for transfer of the ownership. A traditional IRA and a Roth IRA are separate entities from themselves. So that means that if you have a conversion done and you have, let's say, own a piece of real estate, that deed is going to need to be updated via a quitclaim deed in order to convey the ownership from the traditional IRA to the Roth IRA. So Roth IRAs aren't just simply something that stops with its expense on looking at how much taxes you're going to owe. You also might have some other ancillary costs like doc prep, recording, things like that. So again, important to understand that there are extenuating expenses that are going to be related to Roth IRA conversions depending on the type of asset that you have. So a qualifying fair market valuation must be provided by an independent third party who is qualified to value a particular asset. Real estate's easy. Certified appraiser, get it done, cost you about 400, 500 bucks. That's what you need to do. Now, when it gets into things like private stock, limited partnership interest, LLCs, notes, all these other different kind of interesting exotics that we get into here at Advanta, it's a little bit tougher to evaluate. I would always say that a good place to start is a estate planning attorney, because they get into valuing a lot of non-traditional, like non-stock assets for people for estate planning purposes. And if they can't do it, typically they have a resource that can do things like notes, private stock, and all these other things that they need to value for doing accurate inheritance taxes. It's a good place to start for getting something done. Normally a CPA either isn't willing or isn't able to do something like a valuation for a private LLC. Some are, if they specialize in business valuations, they're certainly out there. But just understand your rank and file H&R Block accountant is not going to be kind of the best place to start with this. And all valuations must be done within a reasonable time. For Advanta, our policy is within 30 days prior to the value of the conversion, so that accurate values are obtained and reported. Now, this brings up a really interesting part of strategizing for a Roth conversion. So you have that 30-day window to do it. And remember, Roth IRA conversions are done from January 1 to December 31. So we're getting into a time of year where you have some ability to have some pretty interesting options for strategizing for a Roth conversion. Let's say you have a piece of real estate valued at $100,000, and you have in your current tax bracket an additional $80,000 of headroom before you reach your next tax bracket. And then let's say the following year, you're expecting to take a significant reduction in income. So you can absorb a lot more income in the following year. Well, the cool thing about the end of the year and that December 31, January 1 timeline is that if you provide a Roth conversion valuation and paperwork and documentation, let's say the second or third week in December, we can convert that portion, that that $80,000 of value of that piece of real estate in December, reported on 2022's taxes, and then after when January 2nd rolls around, and convert the other portion, thereby getting all of the money, I should say all of the asset converted in one tax, converted within basically the same time, within the span of a week, and then split the tax bill over 2 years. This can also be done with cash and a lot of other things. Now, that's what real estate kind of looks like, or you can do that kind of same strategy with notes. Again, real estate has to be a certified appraisal. Notes, the fair market value of the loan would be any outstanding principal plus unpaid interest. Now, LLCs, especially like checkbook control or partnerships, can be a little bit interesting. And again, this is something that I must adamantly encourage you to check with a qualified tax advisory professional, like an estate planning attorney or someone that is familiar with doing valuations of businesses, especially when it comes to calculating discounts. So an LLC, if you convert the whole thing, then it's basically the cash held by the LLC plus the underlying asset value minus any outstanding liabilities is going to kick out the value of the entity. That's basically what it is. There might be some other extenuating circumstances that might play into that, but in general, cash plus value of assets minus liabilities is the value of an LLC. But LLCs also have a premium that would be paid essentially for a controlling interest, meaning that if you were to go out and purchase a company, you typically wouldn't pay as much for a non-controlling interest as you would for a controlling interest. That is a benefit to owning something, is that you have a ability to control the entity. You have the ability to make decisions. If you're not, then it might be a slightly depressed value. So in a given year, if you do that same conversion strategy and you have, let's say, a little bit less headroom in a given year, and you convert a minority interest in an LLC, then you are converting something that has an applicable discount to the valuation. So it wouldn't necessarily just be 49% of the cash plus assets minus liabilities. You might have the ability to take a further discount on what that percentage would be, because it's not a controlling interest. Now, this is a fairly well-established principle of valuations, but again, depending on your situation and what exactly goes on and is involved with your particular situation, absolutely check with your evaluator to see if that applies here. I've seen it done in the past. I haven't seen it done in the past with others. So again, you always need to check. Your mileage may vary, but again, that is a particular strategy that might be available to you if you are invested into, let's say, a checkbook control scenario. Because a lot of people, if they buy a piece of real estate and utilize an LLC within their IRA, it might afford them additional options to claim some type of valuation discount as if they as opposed to having purchased the real estate directly. So that's definitely something to keep in mind. And then also, if you have cash in the LLC and you maybe want to reduce the amount further that you're converting in 1 year, you could have the cash from the LLC sent to the IRA, convert the LLC without any cash in it, so it reduces the value, and then maybe convert the cash in the following year if you aren't able to take a discount, but able to kind of play around with what that value of that entity would be. Again, I can't stress enough checking with a qualified professional to see if any of these strategies are right or available to you. But again, there are strategies that go in place that make it so you don't have to just claim a huge tax bill in 1 year. And there are some abilities to, game it to where you split your liability over 2 years, or even able to take a further reduction in the value of the particular asset that you're converting. And if you have other assets, contact Advanta. We'll give you some guidance and help you out with that. So to convert or not convert, everyone's situation is unique. There are conversion calculators to assist your assessment, but there is no way for you to say, hey, I'm converting $100,000. What's my tax going to be? There is no discrete tax that is specifically applied to Roth conversions. It simply adjusts your AGI up by whatever the amount of the converted value or cash is for that given year. Age and projected returns are the most important factors, as well as working with a trusted tax advisor to assist you in making sure that you do something that is in your best interest financially. Because remember, you have to pay this tax bill personally. And also, if this doesn't play into your retirement planning, that can also be a big downfall, big detriment to you as well. And again, don't miss the deadline, December 31st. It's coming up quick. That's why we do these webinars at the end of the year, to kind of remind people, if this is on your radar, on your horizon, now is the time to get cracking on it. Because if you wait after December 31st, again, there's no such thing as a previous year Roth conversion. With that said, I am disappointed that the initial recording got messed up yesterday. We had some great questions and answers on it, but I hope everyone that's listening to this as a circle back or listening to the first time got some good information and value from it. If you have any questions, feel free to reach out to me directly. I am always happy to help people with strategizing for Roth conversions. I find the whole subject pretty entertaining and pretty interesting. So please do feel free to use me as a resource. I appreciate your time today, and I hope everyone has a great rest of their day.